We can clearly see there are massive physical problems in the physical silver market, and yet the silver price is stuck at around $25 US. So that makes no sense.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is John Adams, the Chief Economist of As Good as Gold Australia, the largest bullion dealership in South Australia. John Adams is also a professional economist and writes for his blog at adamseconomics.com. John, thank you so much for joining us today.
Thank you, Elijah, for having me.
Fantastic. Now, I really wanted to have you on because there's, for so many years, been this debate with respect to manipulation of precious metal markets, right? And if people are really interested in learning kind of all the perspectives on this highly debated topic, see a link in the description of the video. We've kind of created a playlist that gives all perspectives on that. But I really wanted to have you on because what we've been seeing since this silver squeeze phenomenon is a divergence between the physical price of precious metals for the smaller bars and coins. And in some circumstances, it seems like it might be hard to get 1,000-ounce bars as well. And we see a divergence between the prices of those physical precious metals and the spot prices. And one of the things you've been reporting on a lot is how there's been so much physical demand, even as we've seen the price fall. And there's been shortages in different places. So just looking at the facts, what we know, where are we right now with respect to physical silver shortages around the world?
So before I get into the answer about silver shortages, I just want to take a moment to talk about market manipulation, because I think it is a very hotly debated topic around the world. Given that I'm a professional economist and I look at statistical anomalies, I mean, I've come to the view after many years of researching this that there is the silver market in particular is manipulated, and it is heavily manipulated. So, I've made a point on a number of other shows, for example, that when you look at the money supply in the Australian context, from January 1980 to January 2021, the money supply has gone up by about 2,900%. And the amount of silver above ground silver stock above ground stock supply has only gone up by about 100%, and yet the price is lower than what it was in 1980. So in the Australian context, silver reached a peak, I think about $44.80 Australian in 1980, and since then it hasn't actually gone above that. And so there's only one good in Australia, or one good, one commodity, one service, given the amount of money supply creation over the last 40 years, which is cheaper than the 1980 high, and that is silver. And we've seen over the last 40 years an increase in industrial demand for silver, many more applications. We are seeing a big amount of investment demand, in terms of around the world, and yet the price is lower. So, for example, even when you look at gold, or when you look at houses or land or food or insurance, travel, education, health, everything is more expensive than 1980 except for silver. And yet you've got this big disconnect between the amount of money that's been created in the economy versus the amount of supply of the physical product, and yet the price is lower. So that makes no sense in terms of my microeconomic training. And one of the challenges I've put forward to a range of economists around the world is if they can come up with a logical, rational answer as to how that makes sense, given what we understand about in terms of basic microeconomic theory, I'd welcome anyone to come forward with an explanation. But in terms of the silver shortages, absolutely, we have seen. So I think Andy Schechtman, the CEO of Miles Franklin, he was talking even before the silver squeeze started in January, that supply was tight, particularly at the retail level in North America. And then since the silver squeeze has started, we have seen chronic shortages right across. No, look, so it initially started in North America, and now it started to spread across the world. In terms of, for example, in terms of the UK Mint last week is not offering any silver bars. There's been obviously massive problems at the Perth Mint, and we continue to see obviously North American bullion retail dealerships struggle to provide supply. So there was an article that I wrote in February, at the end of February, for my website, and it was called "The Silver Market is Faster Approaching Breaking Point." And I pretty much said that we're seeing stress right across the physical market. So we just touched on the retail market. We were seeing examples, and Andy was talking about in February of how that premiums on wholesale buyers were rising. We saw SLV at the beginning of February change its prospectus because and now there's a mismatch between the shares on issue versus the amount of silver that's in the vault, so that JP Morgan is the custodian of. We saw examples of the leasing rates in London in terms of the ability to borrow silver from other banks. Those leasing rates were rising. And obviously, most importantly, at COMEX, where the price is set, the amount of silver in the warehouse, in the depository warehouses, it peaked on the 2nd of February at 399.7 million ounces. And since then, so we're now probably about 9 weeks since the 2nd of February, about 32 million ounces have left the COMEX vaults. And from my discussions with some of the leading experts in the world, there is something significant afoot in terms of COMEX. So we are seeing stresses right throughout the physical market. And obviously that's a complete disconnect with what's happening with the price. And obviously the price is set at COMEX using these electronic contracts. And because we see a mismatch between the price and what's happening in the physical market, I mean, again, I think a lot of investors, particularly new time people to the market, are now coming to the realization that there is a disconnect between the physical demand and supply and the price. And obviously the price is, well, a lot of people are coming to the realization that, that there is a significant manipulation of this market because the price is not responding consistent with what you would expect. And when you look at other commodities, whether it's oil or lumber, or even in some cases the share market in the US or house prices here in Australia, with this massive amount of monetary stimulus that we saw in 2020 in response to COVID-19, we are seeing various commodities and asset classes go up in price. Bitcoin, that'd be another example. And yet gold and silver in particular are struggling. And silver is, we can clearly see there are massive physical problems in the physical silver market. And obviously there are some in gold, but not as severe as silver. And yet the silver price is stuck at around $25 US. So that makes no sense. And I think a lot of people are now waking up to the narrative that there is some sort of manipulation afoot. And we just obviously have to see where we go from here.
Now, with respect to kind of the fundamentals, right, for the future, you have wrote a lot about why gold and silver, you are very bullish on them. Now, can you expand on one of the reasons is because you think that we're going to be seeing stagflation in the future. Why do you see that in the future, and how do you see it impacting precious metals?
Sure. So what I'll do, Elijah, is talk about Australia first, and then I'll get into in terms of the US. So I came out with a call in 2020, about halfway through the year, to say that stagflation has started in terms of the Australian context. And just to explain to your audience what is stagflation, it's low to negative economic growth. You've got high unemployment, but also not unemployment, but also underemployment. So workers who can't get enough hours to work, and you're going to have rising prices. Now, from a macroeconomic point of view, the Keynesians, when you look at their theory, and a lot of it's based on the Phillips curve, when you have rising unemployment because of a lack of aggregate demand, the prices should fall. And one of the problems that happened in the 1970s was when stagflation was raging around the world. Stagflation was a complete contradiction to the whole Keynesian paradigm, and basically, the whole sort of edifice of Keynesian economics that was completely discredited. So as we looked into 2020 in Australia, what I could see was negative economic growth, rising unemployment because of the lockdowns, because of COVID-19, and because of all the. So in the Australian context, we saw in 2020 the largest fiscal and monetary stimulus package in Australian history, and that was obviously going to ensure that prices were not going to fall. So basically, I said that we were going to see. We were not only were we going to see, we were already seeing the first elements of stagflation, and now we are seeing. So at the end of March of 2021, the COVID-19 stimulus package that was launched by the federal government, that's basically now come to an end. So we are going to see a rise in unemployment. We're going to see a rise in terms of underemployment here in Australia, but obviously because of all the money printing that the Reserve Bank of Australia has done, but also the central banks around the world, prices are not going to fall. Prices are either going to stay flat or they're going to rise. And so given that context, that's why I think particularly my call about stagflation in Australia is correct. But in terms of the Biden administration, so obviously when you look at the last full financial year of the Trump administration, I think the deficit was about $3.3 trillion, and that included a lot of the COVID-19 stimulus package that the Congress and Trump passed and implemented. And then obviously when Biden came in, I mean, the deficit was forecasted to be smaller. And what has Biden done? Well, he's improved. He and Congress has approved a $1.9 trillion stimulus package to be spent this year. There's obviously plans to launch a $2 trillion infrastructure package. And obviously there is other spending to come in terms of more stimulus, but also more money for action on climate change. And also you've had a whole bunch of introductions of regulations which have actually hurt the US job market. So from stopping, for example, construction projects like the XL Keystone Pipeline or the US-Mexico border, or stopping fracking on federal land. But also the proposal to raise the minimum wage to $15 an hour, which the Congressional Budget Office said could cost up to 1.5 million American jobs. The Biden administration is, they're hurting the job market. They're making it harder for Americans to find work at the same time that they are running huge amounts of fiscal stimulus. And the US Federal Reserve is obviously, they're giving basically unconditional support to basically let the money printing go. And there is no sign of restraint from the US Federal Reserve or in terms of the chairman, Jerome Powell. So when you combine all those elements together, I mean, that's why I think, and I read the article, that the stagflation process that I thought we were seeing in 2020 is going to accelerate around the world because of the specific policies of the Biden administration.
And we are seeing inflation pick up. We just got yesterday the inflation numbers in the US, the highest we've seen in 2.5 years. So do you see that continuing? I know the Fed is saying it's kind of going to be momentary, right? A little spurt of inflation and then it's going to be less. But what is your perspective? I guess you're seeing that increase of inflation will continue.
Yes. So I mean so probably a couple of points. Yeah. So I do see that the inflation is going to be larger and that is going to be persistent. Look, and one of the big reasons why is that because we have a global debt bubble, and they have to. So every time this debt bubble gets into a problem, so for example, say in terms of the global financial crisis or the sovereign debt crisis in Greece in 2012, or the repo crisis in 2019, or the COVID-19 crisis of 2020, or even when the bond market blew up in late February 2021. Every time there's a point of crisis that could result in a systemic crisis because there is too much debt and too much leverage in the financial system, the powers that be continue to print ever more money to basically keep this debt bubble together. And so as we go forward, every time there is a crisis and you need to print more money to keep the show on the road, the amount of money printing that you have to do, that continues to go up and up and up. And so with, I'm not sure if you can pull up in terms of a chart of whether it's M1 or M2 money supply. And I know that in the US Federal Reserve context, they've actually stopped printing those graphs. I mean, you can see basically the money supply going up vertically now. So that obviously indicates that if the money supply is going up at an exponential rate, and there's no mitigation or any the growth is not being subdued, if you go back to say Ludwig von Mises or even Milton Friedman, the claim that inflation is going to calm down or we're only seeing a temporary bump, that doesn't seem to be holding true.
And now getting back to how this is going to impact metals, are you more bullish on gold or silver when it comes to the impact that inflation will have?
Thing is that so probably probably I am bullish about silver in particular, and look, I should say that in full disclosure, my bullion portfolio is heavily tipped towards silver compared to gold, and one of the reasons why is that a number of analysts have talked about this, and I was just listening to a podcast this morning with the famous analyst Ed Steer, and all the key analysts say that the amount of manipulation and concentration in the silver futures market is that is more concentrated compared to gold. So I do think that when you look at the gold silver ratio, silver is very cheap compared to gold. And so while I have no philosophical objection to gold, and I think gold will go up quite aggressively, the potential for silver to go up, particularly given the gold silver ratio, I do think that is going to be a huge opportunity for like in terms of the investment community, and I think even Indy Schechtman has said that buying silver today is probably the investment opportunity of a lifetime, and I tend to agree with that assessment.
One of the reasons that people are more bullish on silver than gold right now is because the gold silver ratio, it's higher than it has been historically, right? It has come down from its historic high from last March, but your perspective on the gold silver ratio and how that will impact the bull markets going forward.
Sure. Probably making 2 points. I mean, there is a lot of analysis with the gold to silver ratio, for example, over the last 30 years. But if you look at the gold to silver ratio in the context of the last 30 years, you're looking at it during the era of the COMEX. And the COMEX came in 1974, 1975. So even by that standard, we know that, for example, in 1980, the gold to silver ratio went down to 15. And in the bull market of 2011, the gold silver ratio went down to 31. So whether you look at either of those 2 points in time, the rate of return on silver could either double or triple compared to where we are today. But if you look at other periods of economic history, well before the COMEX, I think that there was an article that I saw that another YouTube broadcaster put out last week. And I think in 1919, silver reached 1-to-1 ratio in terms of gold. And I think that price parity happened in the United Kingdom. So in the era where COMEX wasn't available or wasn't invented, we could see a gold to silver ratio that is much more favorable for silver relative to what happened in 1980. Even at a gold silver ratio of 65, 70 to 1, I still would say that silver has a lot more upside potential compared to gold, and because of that, that's why I've heavily invested in silver.
All right. Well, John Adams, we really appreciate your time today and all the insights that you've given our viewers. If our viewers would like to hear more of these interviews, they can hit the subscribe button and the bell icon to be notified of all the new interviews we're doing. And if people would like to find you, where can they go online? Sure.
What I'll say is they can follow me on Twitter, adamseconomics.com. For those people who are on Telegram, I have a Telegram group, Adams Economics. If people want to sort of follow some of my written work, my whole body of work is on my website, freely available to look at. It's adamseconomics.com. And yeah, look, obviously people can look up on YouTube. I do quite a few interviews all over the place. And for those who are looking to buy, in terms of gold or silver, people can email me at John at Adams Economics, or they could sort of go visit the company I work for. It's called As Good as Gold Australia, and particularly if you're in Australia, we're definitely happy to help.
All right, John, once again, thank you so much for your time, and God bless.
Thank you.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.